The Federal Reserve left rates unchanged. The bond market handled the tightening internally. The FOMC kept its target range at 3.50% to 3.75%, but Friday's Treasury sell-off pushed the 10-year yield to roughly 4.75%, and the 30-year yield to about 5.27%. So, the market hiked is not a literal Fed action. It means investors raise the market price of long-term money. That distinction matters because the Fed controls the overnight policy range, not every borrowing rate in the economy. The overnight rate stayed in its chair. The rest of the curve went to work. Long-term Treasury yields also reflect expected future short-term rates, inflation risk, term premium, supply, demand, and uncertainty. When long yields rise, the cost of long-term credit to households and businesses can rise even while the official policy button says, "Hold." Why now? Three dissenters, Beth Hammock, Neil Kashkari, and Laurie Logan, said they preferred a quarter-point hike, arguing that inflation risks remain too high and that modest action now could reduce the need for sharper action later. At the same time, oil and inflation concerns, plus doubts about how aggressively the Fed will tighten, were being priced into the long end. Reuters described the post-meeting move as a twist steepener. Shorter yields softened, while longer yields rose. That is not one clean cause. It is the market combining policy expectations, inflation risk, and the extra compensation investors demand for holding long-term bonds. Then stocks produced the contradiction. The S&P 500 rose 0.7%, and the Nasdaq gained 1%, supported by strong Amazon and Microsoft earnings, even as long yields reached multi-year highs. Wall Street applauded the earnings. The bond market updated the invoice. For high-growth stocks, that invoice matters because much of their value is tied to profits expected far in the future. Higher discount rates reduce the present value of distant cash flows, all else equal, and raise the refinancing hurdle for weaker balance sheets. Strong earnings can overpower that pressure for one session, especially when a few mega-cap companies dominate the indexes. But if yields remain high, the market demands more proof from expensive AI names and less forgiveness from companies still selling the future. Bitcoin belongs in the same liquidity conversation, but not as a guaranteed inverse yield trade. Firm real yields and tighter financial conditions can make cash and government bonds more competitive, while a weaker dollar or improving risk appetite can offset that pressure. Confirmation is simple. Long yields stay elevated, real yields remain firm, inflation expectations stay sticky, and rate-sensitive assets lag. Invalidation is equally clear. Long yields retreat, market breadth improves, and upcoming data weaken the case for renewed tightening. The next major test is the July jobs report on August 7th at 8:30 a.m. Eastern. Stronger labor data could reinforce higher for longer or renewed hike expectations. Weaker data could reverse part of the bond move. Friday's stock rally is not proof that yields no longer matter, and Friday's bond sell-off is not proof that a crash is coming. Policy stayed still, the price of money did not.